Hello everyone, welcome to the second social for Managing My Money. I'm Martin Upton and Director of the True Potential Centre for the Public Understanding of Finance here at the Open University. I'm delighted to be joined by Jonquil Lowe, who's a lecturer in personal finance in the Social Sciences faculty and an expert on pensions. And that's good news because today's social is all about pensions and pension planning. You know that when we planned the first social event, we had so many questions coming in about pensions that we immediately decided to run a special event on that subject only. We invited more questions in week 5 and boy, they rolled in. We've got about 200 questions in total to deal with, and to make it manageable and provide answers to you, we've broken down the subject areas which have been asked about into a number of different categories. I should also say that we can't provide direct advice on people's personal circumstances. We can only provide guidance and a framework for making good decisions about pensions. I should also say as well that there will tend to be, again, a bit of a UK-centric feel to our answers because pensions do vary from one country to another and the focus is on the UK, although many of the things we do talk about apply in other countries as well, and we do talk about cross-border pension planning within this social. That's enough of the preamble. Let's look now at the questions which people have been posing. And a huge number of questions have been posed about the basics of planning a pension. People have asked, how much do I need to put aside to have a good enough pension for retirement? Others are saying, I haven't even started to organise a pension, what should I do? Some are saying, I'm on a low income, how can I possibly afford to plan for a pension? Others had a pension scheme running a few years ago, but then maybe stopped working and that pension pot has remained untopped up ever since. And the number of people who've asked questions about this, as I said, very, very numerous. Marcelo Giraldo, Michelle Inwood, Balijit Kamal, Catherine Casals, Valerie Simpson, Katie Jones, Joanne Knight, just to name a few. And I had one late question in just before we started filming from Andre Mafuto, and he says, well, I've been with a company pension for only 1 year, even though I joined the company 10 years ago. What on earth do I do to make up those 9 years? It's a very common question which has been asked by so many people. How do I plan for pensions when maybe I started too late and maybe I haven't put enough away so far? A difficult area, Jonquil. What do people do?
Well, it's never too late, but obviously the earlier you start to save for a pension, then the longer your money has to build up. So that makes saving for retirement more manageable. So just taking an example, if you're 20 today, to save up for £1,000 a year of pension in today's money, you would need to save about £30 a month, increasing in line with your earnings. But if you were 50, you'd need to save £130 a month. Having said that, it really depends on your circumstances. You can lengthen the period until you retire by deciding to retire a bit later. If your income is quite low, then remember quite a lot of your retirement income is going to come from the state pension anyway, so perhaps you don't need to save very much to top up.
What I'd also say as well is you've got to do some serious budgeting. It's not just about pensions, but it's about going back to what we covered in the first 3 weeks of Managing My Money, building up a budget. You've got to look forward and see at what point you ideally want to retire. Work out at that point what the household circumstances are going to be, how many people are going to be in the household in your estimation, and also whether you've paid off such things as mortgages or other debt, whether there's still university costs or other schooling costs to be covered at that point. And then, once you've determined those facts, you need to ask yourself the question, when I retire, what are my essential non-essentials? And by that I mean, what are the things which, although not essential, I need to have to give myself a comfortable retirement? Ask yourself the question, say you go to the gym currently and you pay gym membership. Is that an essential? Well, it's not really. You can give it up. You can go running around the streets, can't you, around the fields. But for many people, they would say, well, if I can't go to the gym when I retire, that's actually, it's upsetting the standard of living that I want to have when I retire. So do a budgeting exercise, but don't just figure out what the essential expenditures are going to be when you retire. Think about the things which you think you need to have to give yourself a comfortable retirement too. Let's move on to the UK state pension, and lots of things are going on here currently, aren't there, Jonquil?
Yes, they certainly are. So from 2016, we've got a new state pension system coming in. At the moment, you're building up a basic pension, perhaps some additional pension as well, but those disappear for people reaching state pension age after April 2016, and instead there'll be a new flat rate pension. And that's pitched certainly somewhat higher than the basic pension at the moment, and the idea is that it will provide enough to live on without having to resort to means-tested benefits, so a bit different from the situation we have now.
Okay, we've been asked several questions about the UK state pension and the plans to reintroduce the flat rate as well in a few years' time. Claire Coventry, Kim Brinkworth, Andrew Redwood, Roger Wedgwood, Catherine Hyatt, Stephanie Simpson, Michael O'Connor and many others have asked questions about the state pension. One thing which was asked is, can I get my state pension early?
Well, no, you can't. The state pension is payable from state pension age. At the moment that's around 62 for women, 65 for men, but it's increasing. So if you're quite young, your state pension age is going to be 68 or perhaps even later. But having said that, the state system has a lot of other benefits. So for example, a private pension you can claim early if you have to retire through ill health. But if you can't work because of ill health, then you can't claim your state pension, but you can claim other benefits like employment and support allowance.
Right, okay. Well, you told us that you can't get your state pension early, but what about if you are in a position where you can defer it because maybe you're carrying on working, or maybe you've got other retirement income and you don't need to draw down your state pension? Can you do that?
Yes, indeed you can. I mean, at the moment it's quite a good deal actually. So at the moment you can defer your state pension and either earn extra pension or a lump sum. The lump sum's probably not such a good deal because the return you get is linked to Bank of England base rate, which of course is very, very low at the moment.
Yeah.
But the extra pension is paid at quite a generous rate of 10.4% for each year you defer your pension. So you need to survive for about 9 years or so to break even on that deal. But having said that, from 2016, it looks as if you will still be able to defer and earn extra pension, but that rate is probably going to halve to only about 5.2% extra pension for each year you defer. So then you'll have to survive for about 19 years to break even, which is not really such a good deal. Okay,
so a bit of maths to be done there and a bit of forecasting. But questions which have also been asked about the state pension is how many years of contributing national insurance contributions do I have to build up a record to get the full whack, to get the full state pension? What are the rules there? Because they've been moving around, haven't they?
Well, they have. Up until 2010, you had to have a pretty full working life paying contributions. You had to basically pay contributions for about 90% of your working life. But from 2010, that was changed radically. So at the moment, you only need 30 years worth of contributions to get the full basic state pension. From 2016, when we moved to the flat rate, that's going up, but it'll still be quite low. It'll be 35 years. So when you think about the length of your working life, you know, you're talking about 50 odd years, a bit more than that. You can have some pretty substantial gaps in your national insurance contributions without it damaging your basic pension. Okay, that's good news, but what about people who've had very, very long gaps? People basically who may have worked when they were younger but then gave up work entirely to bring up a family, and predominantly that tends to be the female in a partnership, the woman in a partnership. Are they basically going to be penalised for bringing up their family and not working? Well, they used to be, but for a very long time now, since 1978 in fact, we have had protection in the state pension system for people who are not working because they're raising children, or indeed if they're looking after you know, elderly infirm parents as well. Yeah. And that will continue. So basically you get credits as if you had paid national insurance if you're in that caring role.
Okay, there are good calculators to use, aren't there, available online to work out your entitlements, so I encourage you to do that. For those of you in overseas, not in the UK, check out again what your state pension entitlements are, how the system works there, because just going back to that first question, where people are saying, I don't think I'm going to have enough money to retire, well, before you start to panic too much, just work out how much you're going to get anyway through your state pension, and that will give you hopefully some bit of relief. Okay. Now, obviously, a lot of people are in company and personal pensions, and are looking forward to what they can provide to top up the money which they're going to get from the state. But the sorts of questions I've been getting there from people like Carol Ure, Paul James, Mark Stevenson, Beverly Jones, Catherine Dunn, are around the subject of, do I know if my company pension or my personal pension is a good one? You know, what should I be looking at when I look at my pension statements and saying, yes, this is a good deal relative to, somebody else working in another business or somebody else that's working and has got their own personal pension with another provider. I mean, what's good and what's bad about personal pensions and company pensions?
Well, company pensions, there are two different types. So
Yep.
There's a defined benefit scheme that promises you a set amount of pension when you reach retirement. So usually it's a fraction of your salary. The other sort is defined contribution scheme. Now, a defined benefit scheme is, on the whole, the kind of Rolls-Royce of pension schemes. If you're in one of those, that's usually a good pension scheme to be in, so think twice about opting out of it or switching elsewhere. With defined contribution schemes, well, if it's a company scheme, then often it will be quite a good scheme because the employer quite often picks up the charges. So the pension you get is going to be what you can provide out of a pot that you build up, your own personal pot of savings. So what determines how big that pot is investment returns, but also the charges that are coming out. So one thing you can do is look around for low charges. Now this applies whether it's a defined contribution company scheme or a personal pension. All personal pensions are these defined contribution schemes. Right.
Okay, that's good advice. If you are self-employed, what are your options there? I mean, obviously, if you're not then working for a company, what do you do to organise your own pension arrangements there?
It's close to my heart. I was self-employed for well over 20 years.
Right.
It's very expensive saving for a pension because there's no employer to pay in some contributions on your behalf, so you have to finance the whole thing yourself. And your option really is a personal pension in the main. However, you may have heard of Nest, which is a new multi-employer scheme which many people are now being automatically enrolled into through their workplace. But that scheme is also open to the self-employed, so you could join Nest. Okay.
Going back to a subject which was raised when we were talking about pension planning, people have got who were with a company and entered the company pension scheme for a few years and then left the company and maybe are now doing something entirely different. Are asking questions, can I go back and put money into that old company pension scheme? What are the rules there?
Right, on the whole, not. So with a company scheme, there are active members and deferred members. Active members work for the company, they pay into the pension scheme. Deferred members can no longer pay in. They've still got rights that will be paid at retirement, but you can't, as a rule, pay anything extra in to build up that pension further. But again, Nest is an exception. If your employer has enrolled you into Nest, then even if you leave the job with that employer, you can still carry on paying contributions into Nest.
Okay, that's potentially good news, something to look at perhaps. Let's move on to talk about annuities, because as you mentioned, when you've got in a defined contribution scheme and at the point of retirement, until now the arrangement has been that you go and buy an annuity, and that annuity then provides an income then for your period of retirement. And in the UK, and correct me if I'm wrong about this, I think the average annuity you get, it varies between different providers, so you should be shopping around, but the average annuity you get is for every £100,000 you've got in your pension pot, then you should be getting something like 5,500 to 5,800 a year in terms of pension income. Is that just about right?
Yeah, that's a broad ballpark figure, yeah.
Okay. Now, we also know that certainly in the UK, annuities have had a bad press of late, and people are going around saying they're rubbish deals, and and therefore people who are in defined contribution schemes and are expecting to retire soon are looking at the annuity rates and saying, well, this isn't particularly good news for me. But Jonquil, I mean, maybe you've got a slightly different view on annuities in the UK.
Yes, I mean, this is very topical because the government in the budget announced that from 2015 nobody will have to buy an annuity if they don't want to. And people, once they've reached age 55, will be free to take their pension savings pot as they like, as one lump sum, a series of lump sums, as income. It will be entirely flexible. However, annuities do have a place because annuities are not just an investment. They're also insurance. They're like the opposite of life insurance. So you think about life insurance, you take it out because there's a small chance that you might die young, and that would leave your dependents without enough perhaps to live on. So you take out life insurance. Well, an annuity is the kind of opposite. It's insurance against living a long time. And one of the reasons that annuity rates have been falling over the last 20, 25 years is actually because people are tending to live longer on average. So your pension savings pot is going to be used to provide a pension over a longer period than it was for, say, your parents or your grandparents before you. So that's one reason why annuity rates have been falling. Mm. Another reason is because of the monetary policies that we've had since the global financial crisis. So all savers are suffering at the moment with interest rates being very low. But of course what's different about an annuity is once you buy it, you're locked in to that low rate. It's a once and for all transaction. So if you buy an annuity when interest rates are low, then you're locked in. But I really think that insurance element shouldn't be overlooked because, for example, suppose you take a man aged 65. On average, the most common age that he might die is age 85, say. A really unfortunate 1.5% will die at age 66. But there's another kind of 6-7% of people who'll survive until beyond 100. So, where in that scale do you personally lie? You actually don't know. So you don't know how long your savings will have to last. And an annuity is the insurance that, if you do survive a long time, you still have an income to live on.
Okay. Lewis McCann has asked, can you buy an annuity out of your savings? In the sense, can you get an annuity pension product without actually being in a pension scheme? Is that possible?
Yes, you can. It's a different sort of annuity. The principle's still the same. You hand over a lump sum and you get an income for the rest of your life. But then it's called a purchased life annuity rather than a pension annuity. And it's taxed in a different way. So with a pension annuity, the whole of the income you get from it is taxed as income. Mm. But with a purchased life annuity, a chunk of it, which actually, if you're fairly elderly, is a big chunk, is treated as if it's a return of your capital, and only a small part of it is then taxed. Okay. So it's a different tax treatment, but basically, yes, you can.
Okay. Now, the forecast that interest rates are going to start rising in the UK and possibly elsewhere as we go through the next couple of years. So presumably that's good news, a little bit of good news for annuity rates then, is it?
It should be good news for annuity rates, but I have to say, with the changes announced for April 2015...
Yeah, which we'll come on to in a second.
We don't know how demand for annuities is going to hold up. And if the market becomes very thin, then it may not be quite such good news.
Okay. And just one other question on the well, actually a couple of other questions. Jacqueline Redgewell has asked about getting an enhanced annuity at 60. I mean, so what's all that about? That actually you can actually get more if you retire early in the terms of your annuity? How does it work?
Well, Jacqueline, I can't comment on your particular circumstances. That sounds sort of quite unusual to be promised an enhanced annuity at a specific age.
Yeah.
But an enhanced annuity is a higher than average rate that you normally get because either your health is poor or your lifestyle in some way impairs your longevity, so that you perhaps won't live quite as long as average. So things like smoking, being very overweight, having diabetes, if you've had a stroke or a heart condition, those kind of things, then you can get these enhanced annuities.
Okay, thanks for that, Jonquil. And one question which came in from Sophia Darwuji was about, is it a good idea to convert a defined benefit pension scheme into a defined contribution scheme with an annuity? I think you've got to think very carefully about that, Sophia, because as Jonquil said earlier, defined benefit schemes are the Rolls-Royce of pension products. So think carefully. Coming now and just focus again a little bit more on the reforms to pensions which have been announced by the UK government. And I should say, learners, that they are proposals at this stage, and we've yet to see, you know, what the final detail is. So watch this space for the next 12 months on that matter. But basically, in addition to the rule whereby you can access your pension pot, take a certain amount out and invest it where you want to, and you're freed up from the obligation on a defined contribution scheme to buy an annuity. There were other changes as well, weren't there? There are proposals to bring in something called collective defined contribution schemes, or CDCs. Now, what's all that about?
Right, yes. Now this is a subsequent announcement. This wasn't announced in the budget.
Oh, right.
This has been in the Queen's speech.
Yes, that's right.
And in a defined contribution scheme, as we said, you build up your own personal pot of savings with which to buy your pension. And so you as an individual, you're exposed to all of the risks that go around pensions. So you're exposed to investment risk, you're exposed to the risk of a poor annuity rate if life expectancy generally has increased, and you're exposed to the risk of inflation. If prices take off and you've got a fixed income, then it will buy less and less and less. Now, with a collective defined contribution scheme, some of those risks are pooled, and so you become part of a group of people, and the investments in the good years, part of the investment return is held back rather than being paid out, and it's used to top up the returns in bad years, basically. So there's this cross-subsidy going on, which smooths out the risks, if you like. It makes them slightly less risky. But I have to say, you know, it was quite an interesting announcement from the government, because back in 2009 they said, no, we're not interested in these collective defined contribution schemes because of this cross-subsidy, because they were worried that younger people would end up subsidising the pensions of older groups, and when those younger people came to retire, perhaps conditions wouldn't be so good and they wouldn't get such a good pension. We've yet to see any details about this, and it could be that within these schemes, perhaps the cross-subsidy will be for smaller groups. So you might carve up all the members of the scheme into age groups, you know, so perhaps age 45 to 55 is one group, and they spread the risk just between them. Age 55 to 65, another group. But we really don't know. We just don't have the details at the moment.
Okay. They're used in the Netherlands, aren't they?
Well, they are, and interestingly, the Netherlands is actually reviewing them and wondering whether to carry on. And this is because a defined contribution scheme, normally you really don't know what pension you might end up with at the end of the day because of all these risks along the way. With collective defined contribution schemes, they try to set a target pension. So it's not like a defined benefit where you're promised a level of pension, but they do try to set a target, and that's the pension that you're aiming for. But in the Netherlands, what they found is since the global financial crisis of 2007, that markets have been very volatile, returns haven't been as good as they'd expected. And so the members of these collective schemes are now being asked to pay higher contributions and to see a cut in their target pension. And so the Dutch are actually in the process of saying, is this such a good idea, having these schemes, just at the point when we're saying, this could be the answer to all our prayers.
So the Dutch CDC is obviously not performing as well as their football team the other night against Spain, by the sound of it. Okay, thanks. And thanks for the questions in this area on pension reforms from Noel Brosnan and Ruth Barrow. I want to home in on a bit more detail now about those reforms again. And it's about it's in the subject area of lump sums and taking a lump sum out of your pension pot. And obviously the proposed reforms do open up the scope for people to do this if the proposals go through into legislation in the course of the next 12 months. Which I guess in all likelihood they will do. But isn't it a bit complicated in terms of the tax rules, certainly in the UK? How much money can you actually take out of your pension pot without you starting to incur tax? And another question, some people have obviously got more than one pension pot because they've moved from company to company. And as they've moved from company to company, they've set up new pensions with the new company's scheme in each case. So they've got a number of different pots. And how much can they take out of each of those pots? It's a bit complex, is it? Can you shed some light on this?
Yes, okay. Yes, it is. In 2006, the government introduced what they perhaps rather laughingly called pension simplification, because pensions, I think, really are anything but simple. And some people have dubbed it pension complification, which I think is rather neat. But basically, under the current rules, you can take a quarter of your pension savings as a tax-free lump sum. So 25% is a tax-free lump sum.
Good.
You're not actually banned from taking the rest as a lump sum. But, and this is where it gets complicated. If you have small pension pots, so if all of your pension savings are less than a certain amount, which was £18,000 but has now gone up to £30,000, you can take the whole lot as a lump sum. Only a quarter is tax-free, the rest is taxed at your normal rate. If you have a very large amount of pension savings, then at the moment you can go into drawdown, and normally with drawdown there are restrictions on how much income you can draw out, but if you've got enough savings that you've got a secure income, and it used to be a secure income of £20,000 but it's just gone down to £12,000, then anything else on top you can actually take very flexibly as you like. What that leaves is a big group of people in the middle with middle-sized pension funds. And basically they can only have the 25% as a tax-free lump sum. If they take more than that, it counts as what's called an unauthorised payment, and is taxed at 55%.
Blimey.
It's very penal. So that's the big change from 2015, is that you will be able to take lump sums out of your pension pot, but they will only be taxed at your normal tax rates instead of this punitive 55% rate.
So that's potentially good news. But what about those multiple pots? You know, you've got got 5 or 6 different small pots of pensions.
Right.
For pensions.
Yes.
So
if they're all separate pots, I mean, broadly speaking, you can take a quarter of each one as a tax-free lump sum.
Okay.
If you've got an AVC scheme that's attached to a company scheme, then sometimes what happens is a little bit different. So let's say you've got a defined benefit company scheme, so that's going to provide you with a pension that's linked to your salary. If you've been saving in an AVC scheme alongside, then what you might do is take your tax-free lump sum from the savings in the AVC pot. That then leaves your promised pension untouched, and that's often a good idea, because although you can usually swap part of a defined benefit pension for lump sum, the rate of exchange between the pension and the lump sum, if you like, is really often very poor. So sometimes this is a neater way of doing it. So you save in an AVC and use that to provide your lump sum.
Okay, it's a complex area and everybody's circumstances are a little bit different. It's seems to me it's a vital area to get professional advice before making big decisions, particularly with the tax rates which could apply to the money which is being taken out of your pension pots. Thanks to Paul James and Elizabeth Parsons and Marjorie Ireland, who asked questions about lump sums and how they're treated, and Paul Carnell as well, who's looking to invest a lump sum taken from his pot in properties. So if that goes ahead, best wishes, Paul, and hope property prices carry on rising. I just want to focus now for the next few minutes on 3 other specific areas of pension products. And let's start first of all with workplace pensions in the UK. Now they've come in the last few months, and a lot of people are signing up to them. What's your view on workplace pensions?
Okay, well, a workplace pension is just an umbrella term. So your workplace pension might have been in place for many, many years, and it could be your defined benefit scheme. But before what's called automatic enrolment was introduced, companies with 5 or more employees had to make sure a pension was available through work, but your employer didn't have to pay into it for you. The big change now is that we've got a system of automatic enrolment, and employers have to enrol you into a workplace pension scheme, and in most cases have to pay in a contribution on your behalf. So really, that's good news. You don't have to stay in the scheme. Yeah. You can opt out if you want to. Yeah,
I know one learner, I think, has asked, in fact, more than one has asked about whether they're mandatory, and they're not. Right. But you have, if you don't want to be in it, you, as you say, you opt out of it.
Your employer has a duty to enrol you, so he will contact you and say this is going to happen, but you can say no, I'd rather opt out, and that's fine. Every 3 years your employer will re-enroll you to see if your circumstances have changed, but you can carry on opting out if you want to. But bear in mind that opting out is a bit like turning down part of your pay, because your employer is going to pay into that scheme for you.
Okay, it's a good point. Brian Dongo has said, well, okay, I've heard about these workplace pensions, but I haven't got one at my workplace. What's going on?
Right, automatic enrolment is being introduced in phases because it's a huge task, all the employers in the UK. So it started in October 2012, and it started with the big employers. The middling-sized employers have mostly been signed up now, but now we're on to the smaller employers and also some newer employers who've started up in business since 2012. And so the whole process will be completed by early 2018.
Early 2018, okay. Right, so keep your eye on what happens at your workplace, Brian. You could be getting a scheme in place in due course, should be.
And you can always ask your employer, you know,
when it's coming.
When is that going to happen? Yes.
Okay. Thanks as well to Jane Price, Cindy Smart and Sarah Faulkner, who asked questions about workplace pensions. A quick question now on SIPs, just self-invested personal pensions, is that correct?
Yes.
Got that one right. Anne Morris and Daniel Powell have asked questions about this, and the view which seems to be coming across is actually they're a good product. I mean, what are your views on this? Are they special? If so, what makes them special or different?
Right. I mean, basically, they're personal pensions. What makes them different is that you choose what investments you want to put inside them. So with your average personal pension, it's invested in funds, and you usually do have a choice, and it can be a big choice, but it will be a choice of investment funds. Whereas with a SIP, you could have some investment funds, you could have some shares, some bonds, some exchange-traded funds, if you want. So you can have stock market investments as well. Okay,
so it's more about the fact that you can call the shots in terms of what your money is invested in, as opposed to them being, you know, higher performers relative to other pension products, right?
Yeah, they're really for confident investors. So if you're happy choosing your own investments, then a SIP may well be worth looking at. But remember, more choice generally comes with higher charges, and so what you don't want to do is end up paying the higher charges for a SIP, but then just investing in investment funds as you would have done with an ordinary personal pension.
And those fees have to be transparent, so the obligation that everybody who's involved in getting a financial product, including a pension, in the UK, has to be given full details about what those fees are. Don't miss out looking at that detail, folks. Another pension product, drawdown pensions. Questions have been asked by Joy Kavanagh and Jacqueline Pullen about this. What are they? How are they different from all the other products we've been looking at?
Okay. Well, we've been talking about using your pension pot at retirement to buy an annuity, and you don't actually have to buy an annuity even now. What you could do is go into drawdown. So with drawdown, you can take your 25% tax-free lump sum,
okay.
you know, that's yours. Then you leave the rest of your pension pot invested, and you draw out an amount, you know, as and when you like, in a way. It could be monthly, it could be yearly, whatever, in order to provide yourself with the income that you want.
Okay.
Now, they tend to be more expensive because your pot is left invested, so you're still paying for fund managers to look after your investments. And at the moment, the government insists on fairly regular reviews to make sure you're not running down your savings too fast, so that you know you would perhaps run out of savings and run out of income partway through your retirement. But again, 2015, we've got this new pension freedom coming along, and presumably those regular checks will no longer be required, so that may reduce costs somewhat, and it seems likely that there'll be a whole raft of new products, probably straddling a sort of middle ground between annuities, where you're getting a you know, a definite income, and drawdown, where you're still subject to the vagaries of the stock market going up and down. We'll probably see products in that middle ground, and they may have some features rather like drawdown. Okay.
That's great, Jonquil. We've covered the spectrum of pension products, unless we've missed one or two.
I think that's enough.
I think the learners haven't missed many by the looks of the questions they've been asking. But I now want to move on to talk about more general issues which people have got to consider when it comes to managing their pension fund. And we've had loads of questions asked around the subject of consolidation and transfer, if that's the right, an appropriate title for the subject area. For example, if you've got, you know, that situation I described earlier, you've got 4 or 5, 2 or 3, perhaps, different pension funds because you've moved from job to job, okay, and company to company, okay. Now, can you actually consolidate them all into one pot? And does it make sense to do so, or are you best basically leaving them where they are?
Okay, well, you always have the right to transfer your pension out of one scheme.
Yeah.
You don't always have the right to transfer it into another, so you would need to check that. But in general, yes, you can consolidate. Now, when might you not want to? If you've got a defined benefit pension scheme, probably best to leave that where it is.
Yeah, look at the detail closely there.
Absolutely, and you know, perhaps get some advice. If you've got lots of small defined contribution ones, well, certainly when you get to retirement, you'd want to bring them together because, well, if you're buying an annuity, which of course you might not be post 2015.
Given our earlier discussion.
But if you were, then basically you get a better deal if you've got a bigger pension pot. So at that stage, you might well want to bring them together. You might want to consolidate them earlier if you can invest a bigger sum and get a reduction in charges, which is often the way. But you know, also just bear in mind that if you're putting all your eggs in one basket, that is slightly more risky than having separate pension pots.
It's one where you've got to look very closely at the detail because schemes vary. I mean, I worked for 9 years in 2 institutions and transferred between the first 2, and then I moved to another institution and I transferred into the pension scheme for that institution. That last institution had a very good pension scheme, So it meant that whilst I turned up, having had 9 years of contributions to the other schemes, that was only turned into about 4 years and 8 months of contributions in the new scheme. So I still reckon it was a good deal, cross fingers. But you've got to look closely at the detail there, folks.
And it can be a bit confusing.
And it can be confusing, yeah. I said loads of questions. Isabel Ho, Tanya Jones, Beryl Baxter, Sylvia Savage, Vera Muir, Laura Hayter, Karen Lawrence, all asking good questions then about the capability to consolidate pension pots and to transfer. So that is the case, and it's at the discretion of the fund which you're transferring into whether to accept your past contributions. It's not basically at the discretion of the pension fund you're leaving.
Not usually, though an interesting aspect of the 2015 changes is that okay, so the 2015 changes apply only to defined contribution schemes.
Yeah.
Now, most public sector schemes, so if you work in the NHS, for local government, you're a teacher, whatever, you're in the public sector, and you'll have a defined benefit pension scheme, and the government has said it's not going to allow people to transfer out of those into defined contribution schemes in order to get that flexibility, because basically it's just going to be too expensive for the state to pay for those transfers. They've also said that they're going to consult on whether private sector defined benefit schemes, whether the members should also be banned from transferring into defined contribution schemes. I'm sure there'll be an exception for people who are in really poor health. If you had a terminal illness, then I think that there will be an exception.
Okay. That in a sense leads on to the next question area. And here we've had learners Dougal MacLeod and Alex Hunt asking the questions, and I suppose they're looking at annuity rates once again, and what I said earlier is you get maybe £5,500, maybe a little bit more per £100,000 of your pension pot, and people are doing some simple maths and saying, well, that's around about 18 years worth, isn't it? For if you're 18 times 5.5, I think it's quite close to 100,000. So. And they're thinking, well, hold on a second, I might not get any much value out of this, depending on how long I live for. And so questions are being asked, well, okay, is the residual bit of your pension pot, can it be passed on to your children or to other beneficiaries in your via your will? A specific question is being asked, can I front load the income from my annuity? Instead of having, say, 5,500 throughout, I start off with 8,000 and it goes down to, say, I don't know, 3,500 or 4,000 over a 20-year term. What are the capabilities there? And are such sort of thoughts, good ideas or what?
Well, let's start with the last point first, because that really is quite interesting. Usually we think of retirement income as the problem being that you want to start at one level and you probably want that income to increase in future, and that's really for two reasons. One is because of inflation.
Yeah. So
you can get inflation linked annuities, but very few people buy those. Usually people buy a level annuity, but as prices go up, your level income would buy less and less and less. So usually we're looking at a situation where you might perhaps phase your retirement, so you start, you turn part of your pension savings into annuity at the start of retirement, and then another chunk later on to top up your pension to compensate for the impact of inflation. And of course in much later life, health issues unfortunately are more common, and so you might need more income then, actually, to buy care, even going to a care home. So that's quite unusual, this idea of front loading.
Yeah.
But basically, certainly with the 2015 changes, you will be able to do that. There's no reason why not. What's being promised is complete flexibility. So if you wanted to start with a high pension and taper it off, you could. Not necessarily the best idea, though, so think about all
so
the
a lot of
factors.
Flexibility promised with these changes, and really I hope that advice is provided to make sure people are making rational and sensible decisions about this, and I think that's been promised, hasn't it, by the government?
Well, there was some confusion. The Chancellor in his budget speech talked about advice.
He did, didn't he?
But the documents that came out afterwards referred to guidance, which is a little bit different. Guidance tends to be generic, not focused on your specific circumstances. And pensions is really such a complex area. I'm quite sceptical as to whether guidance would be enough. I think most people are going to need individual advice tailored to their own circumstances.
Okay, let's move on to a subject which has been raised by a huge number of learners, including Ashley Robinson, Christopher Bell, Angela Harris, Colin Smith, Jeffrey Cookson, David Lilliston and Gary Hammond, and just before we came on air, Julie Field actually. And this is all around the idea, well, you know, given what I'm seeing in terms of low returns on annuity products and given what's been happening to the pensions industry in recent years, aren't I just better off forgetting about it and then just planning my pension around, or my retirement income I should say, around something entirely different, like buying property and doing buy-to-let, like investing in ISAs, individual savings accounts, because they provide tax-free returns up to an annual limit which you can invest in. And there's even been talk about getting involved in peer-to-peer investing, which is quite a topical new subject. Or simply, if I've got properties, more than one, then why don't I just sell the properties and generate the cash and live off the cash? I mean, are we seeing basically the emergence of a retirement income business which has nothing to do with pensions, which is built around other financial products?
Well, the reason for using pensions, you're right, you don't have to use pensions. There's no compulsion really. The reason people use pensions are the tax breaks.
Yeah.
So with a pension, you get tax relief on the contributions, but the pension you take out is taxed. So in a sense, it's tax deferral rather than tax freedom. However, there's that 25% lump sum on which you've had tax relief when you're putting your savings in, and it comes out tax-free.
Yeah.
So that gives pensions a bit of an edge over ISAs. Now with an ISA, you don't get any tax relief on what you pay in, but what you get out is tax-free.
Yeah.
So in a way, if you paid the same tax rate when you were working as when you were retired, you could say that ignoring that tax-free lump sum, there wouldn't really be much to choose between a pension or an ISA.
Yeah.
But the other factor to remember is that most people pay tax at a higher rate when they're working, because that's when their income is higher. And so usually there is some gain that the tax relief you've had has been at a higher rate than the tax that you then pay on the pension when you get it.
Difficult one.
Difficult one, yes.
But you've got to make sure you get all the details about the tax breaks you do get on pension products, because it's a key part of planning, and also get some idea about what income you might get in retirement, because that's part of the equation as well. So some careful maths has got to be undertaken there.
You asked about property as well.
Yeah, yeah.
So I think it's worth saying something about that.
A lot of people are very interested in it, saying, yeah, I've heard it so many times in recent years, why do I want a pension product? I'm just going to buy a couple of properties and that's basically me sorted. Rental income will provide my income in retirement.
Well, like anything, it's quite risky if you put all your money into one investment, and with property, you know, perhaps particularly, you might find HS2 coming past your doorstep. So
Hope not.
you can't be sure that you'll be able to sell a property for what you hope to, and remember that if it's your second property, then the gain that you make is actually subject to capital gains tax.
Yeah.
So that can take out a hefty chunk. There are also problems with renting. You know, you can have void periods, so you're not necessarily going to get a regular income. Having said all that, you know, property just has performed decade after decade in this country, and maybe the government will eventually build enough houses that the property market stops bubbling, but it's hard to see that happening in the near future. So I can understand, you know, why people are attracted to property.
Okay, but we do cover the risks of buy-to-let in managing my money, so certainly read that step. I want to move on to another area now, and a large number of learners have posted questions about this, and perhaps I shouldn't have been surprised, given that, you know, in recent decades people are far more mobile internationally in terms of where they live and where they work, and this has impact upon pension planning as well. Questions from Vanessa Elliott, Jolante Wantula, Anne Villar, Marilyn David, Stavros Stavru, and Lema Matkevikuti and Nora Hope. To summarise a variety of questions which have come up, I think questions are being asked. If I emigrate from the UK, and I've worked in the UK before emigrating, can I take my pension pot that I've built up in a company or in the public sector from the UK and take it to Australia or New Zealand or Canada or wherever you go? What are the rules here?
Right. Now, in the UK, as we've said, you've had tax relief paying your savings into your pension pot, and so the government wants to be sure that that money and that tax relief are going to be used as intended. So if you transfer a company scheme or a personal pension abroad, you can only do it if it goes into what's called a qualifying registered overseas pension scheme, a QROPS.
Yeah.
So this is a register that HM Revenue and Customs keep of pension schemes that are approved for this purpose.
Right.
So yes, you may be able to transfer it abroad, but it's got to go into a bona fide pension scheme that provides benefits similar to those that you would get in a UK scheme.
Okay, so it is possible.
Yes, it is possible.
Okay, it is possible. Okay, so here's another scenario which has been put by learners. I've worked in a number of countries, and therefore I built up a number of pension pots in a number of countries. Okay, can I still put money back into a pension pot, a pension fund, which I've started in a country which I no longer live in? And I have to assume that that must be something to do with a personal pension plan, because if it's a company pension plan, you couldn't do it, right? No. But with let's just say you've got a personal pension in Luxembourg, one in Germany, one in the UK. Okay, and you currently live in the UK, can you still put money into the one in Luxembourg?
It's going to depend on the rules in Luxembourg, and I don't know the tax rules in Luxembourg. If you were living abroad and had a pension pot here in the UK, then basically you can only pay into your UK pension if you're resident in the UK, but you can still leave invested a pension that you had already built up before you left. Let's
get this clear, because this is specifically, I think, what Laura Hope has asked. I think she's been working overseas. She's got a UK scheme, so can she basically place money into that UK scheme still?
If she's not UK resident, no, she can't.
Right.
She can leave the pot there, and it can carry on growing and provide her eventual pension, but she can't pay any more into it right now.
Okay. Okay, one last scenario. Okay, let's just say that I'm looking to invest in a personal pension plan. I suppose you've already answered this, but let's just check. And I find there's a great one in, I don't know, Switzerland. Actually, that's not part of the EU, is it? Bad example. Maybe Italy.
Okay.
Can I just say, can I sign up to this one in Italy? Because it seems to be offering a great deal. And just live here in the UK and pay money into it? What other flexibilities? Surely Italy is part of the EU along with the UK. Must be flexibility to do that, isn't it?
Well, if you have to think of a pension plan as being like a wrapper around the investments inside.
Right, okay.
So it's going to have to be a pension scheme that is authorised for marketing to UK residents for you to be able to invest into it.
Right.
Having done that, there's nothing to stop you then investing in funds that are investing in Italy.
Okay.
So you can sort of invest in Italy in an indirect way, but you can't on the whole say, oh, there's
a good
Italian pension scheme.
Yeah,
I think
okay, there are different ways to invest in another country, and you don't need to go down a pension route to do it if that's what you want to do. One last question on these complicated cross-border issues, and certainly the need to get the detail is manifest here. One of the learners is working in Ireland, obviously part of the EU, and does that mean that in doing that she's building up her contributions to get a UK state pension? She expects to come back to the UK. That's the feeling I got from the posting. So when you work outside the UK, do you continue to build up your rights to the UK state pension?
the UK has, well, across the European Union, there are reciprocal arrangements between the countries, actually not just of the EU, but a slightly wider area called the European Economic Area, which does in fact include Switzerland. And so, yes, you can pay the equivalent of national insurance in those countries, and it will either help you qualify for a UK state pension eventually, or part of your eventual state pension could be paid by the UK and part by a country abroad. But basically, yes, there are these reciprocal arrangements. Once you go outside the European Economic Area, then it becomes rather different, and the UK does have some reciprocal arrangements with some countries, but not with others.
Okay. Thanks for that. I've got a few short questions to start to wrap up things now, and let's just see if we can deal with these. A few questions asked about taking early retirement, and is it always negative when it comes to how much pension you've got? Is it just a hard and fast rule?
Well, yes, unless you're retiring because of ill health, and then a company scheme will sometimes give you a better pension. And we've talked as well about annuities, enhanced annuities in the example of ill health. But in general terms, if you take your pension earlier, then it's going to be lower.
Get less per annum, basically.
You do. The flip side of that, though, is that if you're looking at a pension that you don't think is enough for the kind of retirement you want, then maybe you can carry on working a wee bit longer and get a higher pension. Okay. So it works both ways.
Consumer protection issues. Now, what about if someone feels that they've been missold a pension? There have been lots of stories about that in recent decades. And what protection is there if something fraudulent happens to your pension product? What are people's rights here? Several people asked about this.
We have quite an extensive system of protection in the UK now, really because of previous scandals. You remember Maxwell?
Indeed,
big hole in the pension fund there. So since Maxwell, we've had the Pension Protection Fund, and that basically looks after the way pension schemes are run. So it focuses particularly on company schemes, but also on that actual sort of the mechanics of running personal pensions as well. But you asked about mis-selling, and mis-selling has been associated mainly with personal pensions. And the whole sort of marketing side of pensions comes under the aegis of the Financial Conduct Authority.
Right.
And so personal pension providers have to be authorised by the Financial Conduct Authority. It means there are lots of checks on them to make sure that they run their schemes prudently and fairly. And if they don't, you can complain to the Financial Ombudsman scheme. And as a backstop, there's a compensation scheme as well. Okay.
What if you thought you were missold a product several years ago, say 15 years ago, and you're now looking at what you're getting and you're thinking, hold on a second, this isn't what I signed up to?
Yeah. In general, there is a time limit of, I think it's 6 years, to bring a complaint, but the time limit runs from the point at which you became aware of the problem or should have become aware of the problem. So even if it's many years after you took it out, it could be that there is something in particular that triggers that realisation that something's gone wrong. And I think what I would say is, always complain. Go first to the company, see what they say. If you're not happy with their response, go to the Financial Ombudsman scheme. If you are out of time, well, okay, they're going to tell you, but have a go and see.
Okay. Rebecca Taylor posted a question about the details which you get on your annual pension statements, and I think Rebecca was concerned that it didn't tell her much about the income she was going to get, and obviously I don't know the full circumstances here, but I just wondered if you got any thoughts about this one.
Right. Well, it's obviously not a defined benefit scheme,
Yeah.
because there you do, your statements tell you.
It's so straightforward to tell you what your expected pension is going to be.
Absolutely. So I'm assuming this is a defined contribution scheme. Now, the statement that you get normally shows the contributions you've paid in and the size of your fund. And you're right, it doesn't necessarily show how much pension you'll get. But you should also get, from time to time, something called a statutory money purchase illustration from your scheme. And that, based on various assumptions, does show how much pension you might get, given the savings you've built up, expressed in today's money. So if you hunt through your paperwork, you should have a document like that.
You should, and when you do get your annual statements, it might not be the sort of the best read which you receive, but important details in there. So don't just put it in the cupboard, don't just put it in the desk drawer. Basically read the details, and if you've got any questions, take it up with your pension provider in the first instance. Okay?
Yeah.
Deirdre Walsh raised an interesting question about people who want to have a complete career change, and a career change which leads to a lower income job because they want to do something different, maybe put something back into the community. And concerns expressed then about if that happens and I'm in a decent pension with my current job, then what happens now when I move into a job which has got a lower income but possibly hasn't got a company pension associated with it? I mean, presumably there, without providing any guidance, if you're in a good pension scheme, you should, I guess the general rule is you just let that pot sit there and carry on, and basically look at the alternatives when it comes to what you can invest in terms of pension products or other savings products when it comes to the income which you get from your new job. Is that just...
Well, yeah, I think so. I mean, it's almost back to where we started, actually. You know, it's worth looking at how much, what pension savings you've already built up and how much retirement income that's likely to provide. And if it's not enough, then even though you're in a low-income job now, you might want to still think about putting some money aside for retirement. But yes, you're right, the pension savings you've built up so far, I mean, you know, they're still there, and, you know, hang on to them, and they'll provide you with some income when you get there.
Yep, okay. And Carla Vardy just raised a question that which is quite interesting. With a defined benefit scheme, are you not allowed to defer receipt of your pension? You know, if say the normal pension age is 65, can you decide not to start receiving under a defined benefit scheme until you're, I don't know, 67, 68? Maybe you're working a little bit longer, you don't need that income.
Deirdre, you need really to
Carla, sorry.
You need to talk to your pension scheme at work, because some defined benefit schemes will let you carry on paying in and building up a bit extra. Usually the maximum is about 45 years in the scheme. There usually is a cut-off.
Okay.
But, you know, talk to your scheme and find out.
But the point about taking it, when you say you retire at whatever age, and then do you have to start drawing on a defined benefit pension at that point, or can you say, I don't need it now, can I just defer it, you know, for a couple of years, and then the income I get from it, hopefully it's a little bit better, or is that not possible?
Well, I think talk to your scheme. I haven't heard of it happening, to be honest.
It's one to...
That's not to say that it doesn't.
Yeah, it's one to investigate, Carla, and best of luck on that one. Moving towards sort of the wrapping up things on this social, one subject here I just want to talk about is we're almost talking about retirement as though it's, you know, the thing everybody wants, and that giving up work is the thing everybody wants. But actually, a good proportion of the population, I would argue, actually enjoy work, and a good proportion of the population therefore probably welcome the development in recent years where there's, for most occupations, not all, but for most, there's no compulsory retirement age. Okay, people like to work in most cases. It's a social environment. It, you know, enhances your self-esteem, and arguably, you know, working a little bit longer is a way of dealing with some of these pension issues, isn't it?
I think so. you know, obviously as people get older, they're perhaps not quite as energetic as they used
Yeah.
to be. And so I think people are often attracted to the idea of, you know, winding down a bit. Instead of working full-time, maybe working part-time. That might be possible with a current employer. Or, you know, perhaps it's an opportunity to look at that second career, perhaps a slightly lower income job, but
Yeah.
something you've always wanted to try. But I think you're absolutely right. You know, we talk about work as if it's negative, but, you know, it gives you self-esteem, it gives you motivation,
Yeah, and
companionship, all those
and people want to
things.
put something back into the community and into the economy, and you know, and certainly, you know, the environment where people were forced to stop working was, I think, a poor one. And I certainly know of many cases of people who, when they were forced to retire because they'd reached 65 or whatever, actually suffered from depression because, you know, their connections with the friends that they built up at work were obviously impaired,
Yeah.
particularly if they worked, you know, a long way from where they lived, if they commuted into London from a long distance, for example. And I know of one guy who, when he retired, said, great, I can go and play golf every day now. But for him, then, golf became the new work.
Right,
And
yes.
after a bit of time, he virtually stopped playing golf. So, you know, it's not such a bad thing, you know, being in employment. And you might want to think about when you want to retire and build that in to the timing of it into that budgeting exercise I talked about at the top of the programme. And that will inform you more about, you know, what pension income you do need.
Yeah, all good thoughts. Yes.
Where can people go to get help and advice if they need it further on this vital subject matter?
Well, there are a number of websites that have got general information. So gov.uk, gov.uk is the government website, which has a lot of information, including about all these pension changes that are coming up. Money Advice Service has good information, all-round information about pensions.
Yeah.
Any you'd recommend, Martin?
Age UK, yeah,
yes,
that's a good one. And pensions regulator.
Yes, indeed, and particularly if you know, we were talking earlier about sort of protection. I mean, sometimes you might, you know, you might feel your employer is not running the pension scheme quite as they should, maybe not paying in contributions.
Yeah.
Pensions regulator would be the place to take any kind of issue like that.
Okay. Well, that brings us towards the end of this social event, and I have to say, first of all, thanks to Jonquil for providing such expert advice and putting us straight on a few things. Certainly putting me straight on a few things. And I also want to say thanks to you, the learners, for providing such a huge number of questions, and very good questions too. I do hope you enjoy the rest of Managing My Money. If you want to know more about finance courses offered by the Open University, why don't you go to the Open Learn platform? Just put Open Learn into Google if you want to get there. And I think that's it. Thank you and enjoy the rest of the course.